My name is Michael Guyette, publisher of the Lead Lag Report. Joining me today is Danny Moses. Danny, I know a lot of people are familiar with you from your own media appearances and obviously 2008. But for those that don't know who you are, quick bio on your background, who you are, what have you done throughout your career, what are you doing currently?
Yeah, sure. Thanks, Michael. Glad to be on here. Came out of school in 1991, was a muni bond analyst at, of all places, MBIA, but not on the bad part, on the part that was covering airports, dormitory bonds, and so forth. I left there, got my MBA, came back on Wall Street, started working at Oppenheimer, institutional equity sales before CIBC ruined it. In 1996, covered a bunch of hedge funds. It was there that I met Meredith Whitney, Steve Eisman, Vincent Daniel. Left there in 2002, went to Freeman Billings and Ramsey, which created a lot of these subprime companies that were the epicenter, obviously, of the global financial crisis, Saxon, accredited home lenders, New Century, et cetera. Saw what they built, saw how the sausage was made there. And in early 2006, jumped and joined Steve Eisman, Vincent Daniel, and Porter Collins over at From Point Partners, where we traded the financial services pad. And eventually, obviously, quickly, right after I was there, actually, is when we put on the trade with Greg Whitman, which was chronicled in The Big Short. And we had a long book, we had a short book, and we had the CDS book. And I think all three actually, for a period of time, worked rather well. I'm left there in 2011. Vinny Porter and I started Seawolf Capital, did that for roughly 5 years, long, short financial services. We did fine. But obviously, when the Fed's doing QE forever, it's hard to really stock pick within the financial services universe. We kind of went our own ways. Vinny and Porter have obviously found great success. Maybe that's because they dumped me. For the last 3 or 4 years, they've been doing kind of family office and have kept Seawolf Capital alive and have ventured out into other areas, as have I. I've been an investor and an advisor in many sectors, everything from cannabis to fintech to biotech to Amazon-related third-party companies. And so I've kind of tried to expand my horizons. And, I think for the first time in a long time, it's not just because I'm bearish. I think this is probably finally an exciting time for people that really do bottom-up work and stock pick and bond pick for that matter. So happy to be on, Michael. Hope that wasn't too much. So
yeah, no, I'm glad to say it's like being bearish can be fun because you can really uncover sort of where the overreactions are on the downside, right? And that's where the fundamental work kicks in.
Correct. Exactly right.
Yeah, totally. Okay. So you sent me a whole bunch of notes, and the one in particular that I want to cover, at least in the beginning stages here, which is you noted that QE began with the Bank of Japan and now ends with Bank of Japan. Now that's why I changed the name of the space to make it begins with Japan and ends with oil, because that's part of my own thesis around credit event risk, which is that if the yen were to keep falling, oil keeps rising, oil denominated yen, then it's skyrocketing. That's a big source of inflationary pressure for Japan. And that's going to really force the BOJ's hand, which could cause all kinds of ripple effects on global markets. First of all, lay out for the audience the QE experiment for the Bank of Japan. Why did they do it to begin with? Just maybe a little bit of a history lesson on that end. And how did that end up being a template for every other central bank? Well,
I mean, they originally wanted to kind of print money. I guess in 2000, to fast forward and come back to 2016, they went to NIRP, which was negative interest rate policy, right? At the time, they've done everything they can to kind of spur on growth. And they have an exorbitant amount of debt, obviously, on all the developed countries. It's certainly the highest on a debt to GDP basis. And prior to us ever going into QE, they were trying to stimulate their economy, right? With, printing money going after it. But they're such an import heavy country, or they became one as far as it is for commodities. And they were obviously exporting things that automobiles and so forth. During the global financial crisis, they obviously got hit, and they kept their foot on the pedal here for a long time. We followed suit. Obviously, Bank of England, ECB followed suit. And now what I believe we're seeing now is the inability, which we first saw last year at this time with the Bank of England, right? which resulted in turnover of a PM, obviously what they can do to stimulate. And now we're on the other side of this. And what I mean by that is anything that these central banks try to do will be inflationary. And that's the last thing that anyone wants, because everyone finally got what they wanted was inflation, but you don't want to exacerbate it. And so unless you have fundamental GDP growth occurring naturally, right, it's going to be really hard to get ourselves out of this. And I think that the market has sniffed this out and seen through. And so any indication, in my opinion, we've seen it, like I mentioned, Bank of England, that you're going to try to print your way out of this is not going to be met well. And rates actually start to move higher as a result of credit concerns. Now, Bank of Japan themselves have the other things going on. They have the yield curve control, right, which they expanded at the end of last year from 0 to 25 basis points on their 10-year to 25 to 50 basis points. What did they do a month ago, or a little over a month ago? They expanded that to say a minimum of 50, maximum of 1%. What happened that day? It went straight to 50, then to 60. They had to intervene again. So it tells you who is the incremental buyer if it's not these central banks themselves that are going to be buying their own paper. And I think that's the scary part of what we're kind of seeing right now. So I haven't looked like you have, Michael, intertwined what it means to inflation related to oil, this, that, and the other. I just know that we're going through a natural kind of unwind, I think. And what that might mean to the market is we've been doing this for 15, 16 years. And so we haven't had to experience kind of the Fed or the global central banks not having your back. And I think that's what this, is kind of coming on upon us here. I mean, look at the Japanese banks, right? They're outperforming massively. Mitsubishi, obviously, MUFG, you can obviously see it there. What the stuff is done. And that's a factor of finally 10-year yields moving naturally higher, maybe to the point where they can get obviously the spread. That's how banks normally trade, right? Is the spread on the short end versus the long end. And so you're seeing opportunities within all of this. And so again, I don't want to be overly bearish. Obviously, there's things you can buy and certainly things that I think you can sell here. So I don't know if I described that perfectly, but there's a lot there. So
and I do want to relate that to the yen because I've been trying to hammer that point about the importance of the carry trade. It's not some new dynamic. It's always been a big driver of at the margin leverage risk taking. So maybe explain the carry trade historically. I mean, I've seen some studies that would suggest that the reversal of the carry trade was actually a big contributor also to the way '08 played out.
Yeah, no, listen, I mean, the carry trade has been, if you can, borrow low and lend high, obviously you make money. Because the Bank of Japan has kept rates so low for so long, you can own Japan and finance it, right? And make the spread by owning other assets like US Treasury, so to speak. But when that starts to diminish and the JGBs or the 10-year yields, let's say in Japan start to move higher, going to their natural levels of where they may be, that kind of comes undone. And you see that in the yen itself, right? Which has gone from 130 up towards 150 here, where I know they're going to make noise and kind of try to come into the market and support the yen here at these levels. And we go through that 150 level, which means it's weakening even further. Look out, in my opinion, because I think you're going to have blow-ups. And I know part of this, we're going to talk about kind of where these leverage trades are sitting on a macro basis across the world. And I think you have this type of volatility in commodities, in currencies, in rates, and all these things we're seeing. Someone's blowing up on the other side of this, right? So whether it's small now and it might get bigger, I don't know. But that type of liquidity coming out of the market, that's why we're seeing this. I mean, U.S. Treasuries themselves are trading, obviously. They trade sometimes in 10 to 15 basis point increments, right? That's just not that's not how it used to be. It's not what's supposed to happen. So I'm watching the yen weaken. I'm watching JGBs, yields move up. So those weaken themselves also. And I think that's a precursor. And like I mentioned, and you mentioned at the top here, I think that's a sign, kind of the end of the belief in QE or global central banks can kind of save us.
You think the BOJ is going to step in to save the yen, or they're going to just try to manage the free fall?
Well, they're going to certainly chatter. They're certainly going to talk it. Obviously, they're going to try to strengthen it, saying we're going to come in if we have to, this, that, and the other. But look at their debt to GDP. I mean, how are they going to basically come in and support it? And for how long can they support it? And so you saw, like I mentioned before, just to go back to their bond market, when they changed their yield curve control and they let it fly from 50 basis points, it immediately went up 10 basis points, right? Which is a big move on a percentage basis. What they do, they had to come in immediately and say, okay, just kidding. We're going to buy some here. Goes to 65. We're going to buy some here. Goes to 70. Hey, we're going to be active. So I think it's a lot of talk. And I just think, like I said, they're the source, right? They're the source of the ones that I think are going to try to come in and buy their own currency. They're the source for who's going to come in and buy their debt. And with their debt to GDP where it is, that can only go on so long, right? Because the yen, I feel like, is going to go off. If they keep doing that, will eventually fall off of a cliff here. So to me, that's a scary part. And I think that's just not priced into the markets.
Do you think it's priced in more into Treasury yields on the kind of more intermediate side? The reason I'm saying that is it is true. And you noted this in the notes to me. I mean, you've got the Fed doing QT. You've got China and Japan, being net sellers, right, on the Treasury side, because they're trying to manage their own currencies, right? That's part of the mechanism. So it seems like a lot of the Treasury, in quotes, investors and traders, they're much more sensitive to what's going on.
Yeah, certainly, comes down to supply and demand for any asset class. And you said you're competing against the Fed with quantitative tightening, right? Selling tens of billions a month. You're competing with Treasury, obviously issuing debt, right, to pay for government spending. You're competing with foreign owners of our Treasury, China, Japan being the biggest. And the tick data did come out last night. It's a 6-week lag for the month of July, and it actually was flat for Japan, surprisingly so. So maybe they sold some in August, and China, I believe, sold some as well. But who is the incremental buyer here, I guess, is the point that I'm making for U.S. Treasuries, right? And we are literally trading out every day that goes by 1% paper for 5% paper. And I don't have to anyone that can do math on that, obviously, over a period of time when you reset. So I think the fast forward will end up happening, I believe over time, is that the government, U.S. government, will lower regulatory requirements for the big U.S. banks that hold treasuries. And I believe that quantitative tightening rather than Fed cutting rates will be kind of the first thing to go. Not to get ahead of ourselves. A lot has to happen between now and then for that to occur. And I don't want to even think about the point where you start to worry about the credit worthiness of the U.S. government or U.S. paper as meaning that's why yields are moving higher. I'm a big believer that at least for a period of time that 10-year yields in the U.S. are going to come in a lot. And I think that'll happen in conjunction potentially with, a large sell in the equity market potentially.
Well, right. Which is basically the flight to safety trade. That's been my hell the last year and a half, 2 years is the complete failure of that flight to safety dynamic. But if that's going to happen, you need to have credit spreads widening. I'd argue to kind of shock that behavior back in place. And that's been one of the more frustrating aspects of the way asset markets, the bond market's behaving. I'd argue spreads just keep getting more and more narrow as far as junk debt relative to AAA of the same duration.
I don't think there's a lot of stuff trading per se in the corporate credit market as much. I think you see the haves and the have-nots. I was just on a call where, you really can't look at the HYG or the J&K itself as a proxy because there's such a mix in there. You have energy companies, which of course you would want to own right now, who have cleaned up their balance sheets and look great, right? And then you have potential things like airlines, right? Which I would never want to own. So again, as I mentioned at the outset here, I think what's exciting here is it's a bond pickers market as much as it's a kind of a stock pickers market. And, to your point, I don't know what the day is going to be when credit spreads really start to blow out or not, or how long the lag impact is that we're going to kind of see that happen over time. But if rates stay up here for this long, U.S. Treasuries and 2 years in the funding markets and 10 years just kind of as a biggest proxy out there, believe me, credit spreads will start to widen. And we're just now starting to see kind of the lag effect, the inability to pass on prices, right? People have done a great job with their balance sheets for now. But I think if the U.S. consumer starts to run its course and it looks like it's starting to get a little bit tapped out here, obviously, I think those things will start to happen. So I believe we're going to widen from here.
I always go back to the precursor to every hail event is overconfidence, because overconfidence creates leverage, and leverage is what creates the margin calls that results in the air pockets, right? The kind of real extreme decline, just mechanically speaking. Let's talk about, since you alluded to it a little bit earlier, pockets where leverage is maybe underappreciated in terms of how high it is and how much risk it could be. So you had mentioned multi-strat funds. I'm assuming you mean more than kind of risk parity type strategies, which lever up treasuries, obviously. But where are some of the higher risk levered areas from an asset allocation perspective that could be a source of pain?
Now, listen, I think it's everywhere. I think if you think about, I'm not naming any, I don't know anyone that's in trouble at the moment. I'm not trying to name anybody. I'm just saying in general, leverage is about 4, 5, 6 times in some of these areas. And when you think about just a long short equity portfolio, just to keep it simple, right? The cost to short or the cost to borrow has gone up dramatically, right? So you better be right over a shorter period of time if you're running that type of leverage, even on the short side of the market. And so I think all it takes is the banks themselves, the Goldman Sachs, the Morgan Stanley, the JP Morgans, to start turning down leverage a bit on areas where they see exposure. Again, they put it all together, right? They can kind of, amalgamate this thing and say, okay, we are way too short oil as a bank because we're providing loans to these funds or whoever might be there doing this and so forth. And so when things get one-sided like that, and it feels like there are certain areas of the market that this is why you see this type of volatility. And I think when that leverage starts to basically come in and you turn it down from a 5X to a 3X, depending on what that product might be, Michael, again, I'm not going to, name anyone in particular. Just know what you just talked about, kind of why haven't credit spreads widened and so forth, or why have asset prices held. I think we're at the beginning stages of, okay, we got to turn down the leverage and kind of get the tap on the shoulder. And the other important aspect of all of this is, for the first time in a real cycle, we've seen kind of pockets of it. The Wall Street banks themselves can't play middleman as much as they have in the past. They just can't. I mean, they don't have capital to do it. They have the capital to do it, but they're not going to take that risk to do that. And so with no kind of intermediary that can hold those assets or take those over for a period of time, I think that really puts more risk into the system. You look at an Archegos, which is kind of a one-off and not a great, example, and they obviously broke the law because they were hiding what, leverage was. But you look at, let's keep it simple, 7 banks had $10 billion each, right? It was 20 billion levered 4 or 5 to 1 or whatever the number was, right? It took nothing to send those equity prices of those 4 or 5 stocks that they held down 50 to 60% in a period of a day or two, right? Large market cap. So my point is that's not exactly what's happening. My point is a couple of those or really ones that are institutionalized throughout the system can really wreak havoc. I can't think of the name of the energy fund over in the UK, right? That literally was taken out of their long oil trade. I mean, think about this. Long oil trade at 60, when oil hit $65, they were taken out. They lost billions of dollars. They were right, but they were taken out. So all of these things, whether it's long-term capital, whatever it be, always start for one thing, and that's leverage in the system. And when they make the phone call to turn down the leverage, if there's no incremental or other side of that trade or book to take that trade over. We saw Amaranth with Nat Gas, all this stuff. That's what I'm talking about. And I feel like, without naming that there's one particular party that's really at risk, whatever, I think there's a lot of little parties at risk, but that may all own the same type of thing, Michael. So that's kind of what I'm talking about when I look at all the volatility across the markets and various product categories.
Yeah, and I've thought about that too, just in terms of even the zero DTE manic volume activity. I mean, that is leverage, right? I mean, options are another way of getting leverage. So I do wonder if that also becomes sort of a unmodelable, if that's a word, right, source of risk.
Well, those are, zero sum game, right? There's a seller for a buyer. Someone has figured out a great equation for gamma, which is probably not what we're going to on this call. But, I think there's a formula there that's been working for certain funds or people that have figured it out, certain quant funds that have figured it out. Again, not breaking the law. I just think taking advantage of market structure, right? And feeding. And I think retail investors feed into all of this. And I think they're the ones that kind of lose at the end of the day. Right? It's the professional institutional quant traders or the funds or people that actually have staying power to either buy those dips or sell those rips, whatever it might be. So again, that to me does not feel like it's a big factor into market integrity as much as it is just something that I think is getting abused. But again, you can use that to your advantage, right? I mean, if you should be selling stock in companies that are being juiced up on gamma from long call options, things like that.
So you have this thesis, which I agree with, and thesis with a lot of the analysis I've seen around availability of credit that, there's going to be some real pain from, the smaller businesses, those that are not at scale. So the Fed may end up pausing, right, as far as interest rate hikes, but other interest rates will rise relative to who's borrowing, right? How do you think that plays out? Because first of all, that would be happening into an election year, which becomes just a whole other complicating factor. But it seems to me like smaller businesses are just going to, really suffer while, the larger ones will be okay, which unfortunately is almost always the case, but maybe in this case, much more accentuated.
Yeah. The ones that don't have the economies of scale, ability to be big enough to leverage some of the big banks themselves. No one in their model when they were in 2021 and 22, when their lines of credit were literally just sitting at 1 to 1.5%, right? Factored in what it would be if it was 7, 8, 9, 10%. And post Silicon Valley and Signature Bank and all this debacle, right? Their cost, right, of what they're now required, their debt's trading at 8 to 9%. The banks themselves, some of these regional, so they need to earn 11 or 12. And what's happening is the bigger banks are going to get bigger. It is what it is. And the access to capital for what you just pointed out, kind of the smaller businesses, which is the driver of employment in this country, is becoming harder. So I believe that's going to have a ripple effect. And we're seeing that in real time right now of lines of credit that are being reset, right, or closed and are not going to be available to these companies. And so, listen, we've gone through a period for the last 15 years where, and who knows, QE 7, 8, 9, 10 could be coming in years from now. But my point is that the Fed had your back. I mean, the Fed was buying HYG, right? That we could do all these programs and things are going to be fine. I just feel like I think the reality is starting to set in that at least for a period of time, this adjustment to the new normal, what was the old normal, is happening. And so if you have a good business model and you can, bet price increases and run your business, you will be fine. You'll just make less. But there's a group of businesses out there that probably can't function with double digit rates, that can do it at 1 to 2%. That's a big difference to the bottom line. And so I think that's what we're seeing. Again, it's slow motion. Nothing ever happens all at once, but it feels like the lineup right now where we sit right now is kind of, it's not a pretty picture, Mike.
Yeah, I mean, right. I mean, basically it's the smaller companies that have like very, super thin profit margins, right? I mean, those are the ones that are going to be most at risk. And that relates to the zombie company dynamic in general, which I think is also why small caps and breadth just isn't there in what everyone screams about as far as the new bull market. A lot of these smaller cap companies in the Russell 2000, they're highly levered. They may not survive on those higher rates. And obviously that's playing in a bigger game than the small businesses that are in the private markets. But it does seem like we have yet to see the real impact of the level of rates and the, who can benefit from the Fed stopping versus default risk getting repriced in. affecting their actual loans.
Correct. That I totally agree with. And I think banks are going to keep going in and, curtailing lending in certain areas and be much more selective of where they put their capital. And, I'm seeing it. I have friends that have $200 million revenue type businesses that are moving from KeyBank, that were forced to move from KeyBank, right? Because KeyBank came back at SOFR plus 450 and Wells Fargo, JP Morgan are there at SOFR plus 225. Think about that spread. That's a huge discrepancy. He has the ability to move his business because it's big enough, right? But some of these other smaller companies, businesses don't, because they're not going to get the time of day from some of those bigger banks. And so it's a real issue, certainly.
What about other sort of like historical leading indicators of credit contraction? So you mentioned, and I've seen these headlines too around some of these auto lenders getting out of the business. BMO recently is the big one. Maybe talk through that. First of all, why does that matter, and how does it impact the economy, and how is that a signal?
Well, it matters because the cost to own a car, own a boat, or whatever you want to finance is going higher, right? So forget about the price of the car or the boat. Financing it, which is really all that matters at the end of the day, is going to cost a lot more. And if banks are pulling out of that kind of lending for whatever reason, whether they feel like car prices have gone too high and are not sustainable, they're going to start to pull in, or they're worried about the U.S. consumer, or they'd rather lend that to somewhere else, or they're forced by the regulators to kind of pull it in. They're seeing stuff out there, right? And so the risk reward to lend in those particular areas isn't great. In the U.S. consumer, we've seen the credit card debt. We know about student loan payments. People say it's not a big deal because they're probably not the ones that are impacted by it. But a lot of the stuff kind of starts to add up. And there's a lot of floating rate debt that's sitting out there right now. And there's some unseasonably moves higher in watching these pools and securitizations. And the other important thing here, Michael, is that this is such a financialized economy, whether it's auto loans, home loans, boat loans, whatever it might be, credit card receivables. And it all starts in the short-term funding market. It all starts in the ability to produce a loan and to have the ability to sell it so I can clear my balance sheet and do it again. And we're seeing that back up. Again, it's not cataclysmic. It's not like it was in 2006 and 7. But when you start to see firms like Upstart, right, who start to portfolio, who have this great AI platform because they reinvented lending. And you know what we're going to do? We're going to hold some of these loans ourselves on our balance sheet. That was never the model when they went out. That's not how you get a high PE multiple. And so what you're going to start to see is this stuff backing up in the system. That's really all this is. And so this is a normal cycle that no one has had to deal with now for literally 15 years, because we had a little bit of it in 2015, a little bit of it in 2018, but the Fed's not cutting anytime soon. And even if they were to cut, I don't think it's enough to kind of fix these markets. So long-winded answer to the question that you asked, but I just think in general, I just think that credit has been mispriced for so long. And I think now people are looking, the banks are forced to look at it on a bottom-up basis. And I think they're making smarter credit decisions. But unfortunately, that means less credit availability to the consumer.
So markets are, we can debate how efficient they are, but markets, largely do discount a lot of information, obviously overreacts and underreacts. What parts of the marketplace do you think are more properly priced relative to the credit contraction, which will accelerate, and which areas are maybe more vulnerable?
Energy is one that is not vulnerable, that has obviously cleaned up their balance sheets over the last 3 to 5 years because of ESG and other things that historically would always be vulnerable to debt prices moving higher, but they're now sitting in a catbird seat. I'm certainly concerned on the airline side of things. Again, here we go again, the most cyclical trading stocks. I'm not involved in them right now on the long or the short side, I will add, but something I watch kind of as a proxy that's hit on higher oil prices. It's going to lose the ability, in my opinion, to kind of pass those on who don't have pretty balance sheets. The big banks, I think, are obviously fine, stuff like that. But there's various pockets of things which certainly are concerning. I think more in the fixed income market, like I just mentioned, on the securitization side of things that I'm watching. And so office property companies, office REITs, things like that. I just think, again, this stuff's going to start to matter. You're seeing these type of defaults that are out there. So it really, even within each sector, I think there's longs and shorts that are kind of out there. So kind of keep my eye on everything. But again, just keep in mind how financialized everything is and how structured things are and how we built the last 15 years on an economy that, rates will always stay low. I mean, that's all. I think this is just natural, evolution of what a normal cycle potentially looks like. And so again, I would be wary of companies that have a high debt. And it's easy to find, by the way, what their debt looks like on their balance sheet, EBITDA, debt to EBITDA, and when is this debt coming due? I mean, the market's going to price that way ahead of time, right? And they're going to start you'll wonder why a stock's trading lower when things look great. Oh, because they have debt due in 2024. early 2025. And so it's really sector by sector basis. Michael, it's not general at all. And some of these companies have done a great job with their balance sheet. But the days of, borrowing to buy back stock, you think about things like that, just you're not going to get the bang for the buck anymore to do that. That stuff is kind of gone.
Yeah, no, for sure. On the buyback side, that's going to be a longer term headwind. And I'm glad you make that point because that part of my thesis at the start of the year for why, melt up, but then credit event towards the end was the market will start to see, or at least the bond market will start to see that you've got a lot of refinancing risk next year into higher rates. So it's not going to respond off of it as the rollover is happening. It would happen in advance. Now, presumably the Fed sees the refinancing risk that's out there, right? They have got to be aware of not just the treasuries that are going to need to be rolled over next year, but also on the maturing post-COVID loans on the corporate credit side. And I'm with you. I don't think they're going to necessarily, it would take a lot for them to pivot because they don't want to get whipsawed. But do you think that there's anything the Fed could try to do to at least calm the risk of refinancing dynamics next year? You kind of allude to QT as an answer, but I'm not sure that would be as direct of a way of solving the refinancing sort part.
I mean, if things are real hairy, honestly, I hate to think like this, but look, they'll open up a window, let you pledge corporate securities. I mean, come on, they were buying the HYG and the J and K and, right during COVID, right? Obviously. And so I'm not saying that they're going to do that. We're a long way from that happening. But again, I think that's the way that, kind of people are somewhat programmed from a moral hazard perspective to start to think about things. And we're a generation removed at this point from anyone that traded bottom up, for the most part. That's a little bit dramatic generalization. But my point is that we've only known the ability to print our way out of problems. And I think that's, that goes into every corner of this market. And so we're a long way from, I think the Fed intervening in any way on the corporate side. But look what they did. They didn't see the bank thing coming. And the next day, they open up the window and create another new acronym. They're going to run out of acronyms at some point, Michael, obviously for these programs that they can have. But, there's ways to do QE without calling it QE. And it would not be surprised in next year at some point if they have programs for corporate debt.
Yeah. The one thing that Fed's creative at is creatively preventing creative destruction and then coming up with funny terms to just explain it. Let me reset the room for the remaining minutes. Everybody, please make sure you follow Danny Moses here on X. If any of you want to come up and ask questions, click that bottom left mic request button. And as I mentioned, this will be in a podcast under Lead Lag Live. Okay, so let's talk about your portfolio to the extent you're comfortable. It doesn't sound to me like you are all in long, but you can manage a net position where you're still long, but you've got some shorts to counter. How are you? Are you aggressively positioned for any one particular direction in the here and now? Or are you just doing longer term investing or sitting in cash? What's sort of your own management?
Yeah, I mean, I'm long gold. It's my largest allocation. I think nobody owns it. I think that none of the institutions own it. I think the global central banks own it. And it will not be hard to see gold move substantially higher, 2,300 rather quickly, in my opinion, because anyone that's bullish on the stock market is bullish because they believe the Fed's going to save you or come or, some type of QT ending or something like that. And that will all come that will all benefit gold, in my opinion. That's one area. I am short all of these kind of platform companies, the buy now, pay laters, the upstarts of the world to some degree, right? Whether it's forward put options or outright shorts. I just believe that's just a matter of time. I just don't think those are going to make it through this kind of credit cycle. Long kind of sports gambling stocks. I believe that both cannabis and online gambling are two areas of growth and what I think is going to be a stagnant to contracting economy, sources of tax revenue, sources of jobs. So I'm long. Those are kind of unloved in my opinion. So you can own those. Long some energy stocks, long some uranium stocks. And trying to think what else running around. So I'm short the S&P again versus using SPY puts. And I am inching towards going long duration U.S. Treasuries. I own those personally. I roll kind of 6-month T-bills, but I'll keep doing that. I think that's a place to be. And that's kind of it. So I guess you could call that a bearish portfolio setup. But, again, I kind of react to what's going on out there in real time. And listen, I've been around long enough now to know that when the Fed does indicate that, well, they're done, but when they indicate that they're really moving more from a less hawkish stance, there could be a rally in the markets. I'm not an idiot. I'm well aware of that. But again, that's why I love gold, because I think that kind of solves that. I think being long gold here is effectively being short the S&P. There was a lot.
Yeah, I myself have argued that gold probably does break out if you have any kind of high vol juncture. And listen, seasonality wise, whether you think it's hocus pocus or not, anyway, September, October, like this period tends to be fairly volatile regardless, right, of whatever the Fed likely does. I am curious on the cannabis side, because that's been a heartache area to invest in, as you know, for a while. And there's been a lot of chatter. I mean, I'm friends with Todd Harrison, and he's been talking about SAFE for a while and all this. But any interesting catalysts going on the cannabis space, or is it just sudden momentum that's kicking in? What's going on there?
Oh no, there was a big event a couple of weeks ago. So last year, President Biden instructed Health and Human Services to undertake a review of cannabis as a Schedule I drug. Schedule I drugs are heroin and LSD and meth. Cannabis has been there since 1972. Nixon did that for obvious reasons. Won't go into that. And so he instructed Health and Human Services to look at it. It took about 9-10 months, and all of a sudden, a couple of weeks ago, unexpectedly, I think from a timing perspective, because as you mentioned, every kind of legislative pro move that we thought would happen within the sector to help it, whether it was safe banking or whatever, has kind of fallen by the wayside. Health and Human Services, along with the FDA, said this should go to a Schedule III. Fentanyl, for those that is a Schedule II drug. But what that does is, so now we're waiting. It could take a few months, obviously. So the DEA takes that into account, and they could approve it. And you don't need Senate or the House to approve this, right? This doesn't need that. And so what happens with that potentially is you don't even need safe banking, because the reason that banks can't deal in cannabis is because it's a Schedule I drug. It's money laundering, it's KYC, it's all that stuff. And so it really will provide cover for these companies. And yes, these companies have been forced to take out loans at very high rates. They've been forced to issue equity nonstop. But at the end of the day, the macro has been extremely strong. I think 41 states now have some form of either rec or medical cannabis in the state. And listen, the alcohol industry, the other thing this does is potentially paves the way for alcohol and CPG tobacco companies to come in. I mean, Schedule III really opens the door for a whole host of people to kind of come in and get involved. And I'll end by saying alcohol is well aware of the market share that cannabis is currently taking. And they're looking, obviously, we know Tilray, Constellation, they've all tried to kind of do things. And of course, you're going to be early and wrong just from a timing perspective, but it doesn't mean that they weren't right. And so it feels like it's finally coming together. And again, I think culturally it's been accepted more. And so the macro is very strong. You just got to know which name's going on the micro here. So stay tuned on that one. Yeah, I mean, I think there's a lot in there, again, without understanding how people are hedged. We all know like mortgage convexity and things like that, the ability to need to go long treasuries because you have a mortgage book, so to speak, all this stuff. I think it's being, with quantitative tightening and $95 billion a month of mortgage-backed securities and U.S. treasuries being sold right into the marketplace, it's hard to tell. Like, for instance, if they announced the end of QT quarter, I think you would agree the entire curve would collapse upon itself, right? I mean, at least on the longer end would. And again, there's too many forces at work to try to pinpoint it. But I can see a little bit of, it's going to stay higher inflation for longer, potentially. I can see a little bit of credit worthiness of the U.S. You certainly can see debt to GDP and the need to continuously issue treasuries now and extend and pretend for a long period of time. I mean, but again, I can't explain exactly, but to me, there's no question that this inverted yield curve and how long it's been inverted is a precursor to recession, because I think it's 100%, tested experiment that's going to happen. And I think it's going to actually go to, I think we're going to have a period of time here where we'll go to 130, 140, basis point inversion potentially. I know that sounds dramatic, but I could see 4.9 and, 3.6 rather quickly. And so again, I'm a buyer of long-term U.S. treasuries, because the reason not to own them is because we're concerned about the credit worthiness of the U.S. We have much bigger issues, in my opinion.
Can I just ask, because it's something that's bothered me for a while. I brought this up to others. It's like, all right, so I thought AI was supposed to be a longer term disinflationary or deflationary. And yet, the long end is not acting like that at all anyway, right? I mean, you talk about 30-year treasuries. I understand, obviously, there's a connection to short rates, right? But
that's a duration change, but yeah.
Yeah, no, I understand. But I'm saying it just seems like there's still a disconnect in terms of even the AI narrative and what that means for very long-term inflation expectations.
Well, I mean, sell U.S. treasuries to buy NVIDIA, right? You just got $400 billion of market cap on a $5 billion increase in revenue. So there you go. So why would I want to own U.S. treasuries when I own something that's worth trillions of dollars? Obviously, I'm joking here, but point is, I think at the end of the day, what will make U.S. treasuries yields move lower, at least on the longer end, is money coming out of, tech. And I think, just to go back on this, I think, there's a little bit of so many different cycles, and cycles always kind of rhyme. They're never exact, but you got a little bit of 2000, 2001. You got a little bit of the GFC from 2006 and 7, right? You got a little bit of everything kind of tied in here and plug and play on whatever the asset is. And it's not housing this time. It's potentially tech stocks and CRE, right? Versus housing. So there's always a problem kind of sitting somewhere. But with oil at these prices, and so I just don't see how, things aren't going to slow down dramatically. So I think we're going to have a snapback in yields. I do. Whatever that means, I don't know. But I've said for a long time, when the 10-year yields were back to kind of 3.5 level, I think it was last year, and things looked okay. I'm like, if you're bullish on the stock market, you actually want yields to move higher from here because it's telling you that you can get through this, right? And that was before the 2-year shot up. That was before I never thought the Fed would raise this much. I just didn't. I mean, and I still think they probably have made policy error.
Can I say something? Because that's what kills me about just the hindsight bias I hear in a lot of media. Like, 'cause I've done over 500 of these spaces, right? So I had plenty of them all throughout last year. And sometimes I revisit the titles and the guests. And I remember there was not a single person, guys as smart as you, as experienced as you, who ever imagined the Fed would do what it did. I mean, most people were expecting. I had Jim Bianco on once, I think like February of last year, and he was saying, the Fed's going to peak out around 3.5-4%, right? So it's like, and he was actually probably the most aggressive. The point is that we always play the hindsight game, but the reality is the Fed didn't know it would go this fast. No pundit said or analyst said it would go this fast. So, and because of that, nobody knows what's going to happen next because there's nothing in history that shows what happens when you have this fast of a move.
Yeah, I think the Fed compounded the mistake of transitory, I believe, with over tightening here. And the one thing that I think we've all, or I shouldn't say all, but the fiscal stimulus, I think, was undercalculated or underappreciated, I think, especially on my end in terms of what that did and how it spurred on. But I do believe, as much as I don't like the Fed, is what it is. We got to deal with them. They have overdone it here. And, again, people talk about, change the samples to 3%. Go to 3% is what your target should be. No, it'll work its way to 2 over time, obviously one way or another. It's going to be painful, I think, to kind of get there. But I just didn't understand the 475 basis points. I mean, that to me, and again, people think that it's okay. No, it's not okay. The lag impact is right now. Like it's happening right now.
Thank you.
Right now. And again, you called recession. We're calling a normal cycle that's going to occur. Why are people so scared of a recession? And by the way, you can have a recession and the stock market doesn't have to go down. Although I think in this case, where to Porter's point, where the market is, it will go down if we are in a recession. But that's backwards looking. We won't know if there's a recession starting now, and it turned out that it was third and fourth quarter or fourth quarter and first quarter of 24, and then we find out in June, there was a recession. Doesn't help any. It doesn't mean anything. Point is that the market will already discount that. And so I just think that people that believe there's no impact, that we have a soft landing, no way. There's no way because structurally for the last 15 years, this economy was not built on that. It doesn't work. It's not going to work with rates this high for this long. It's just not.
Good way to go full circle with the start of the space, which is QE start with Japan and oil or Japan, right? So maybe final thoughts from you, Danny. Just are we going to look back with hindsight and say Japan was always sort of the real part of the financial landscape to focus on?
Yeah, no, listen, like I said, it started there. Demographics are different, right? They've just mentioned the growth rate was different, right? It's different. But I think you're going to see the new BOJ Governor Ueda be like Bud Fox in Blue Star with the shortest career known to mankind. See if he can kind of make it through this. But, it's not a pretty picture over there. And now they finally got inflation, but the cost of living is outgrowing wages over there. And so again, there's really no way out, and there is no incremental buyer of JGBs, Japanese treasuries, right? It's the BOJ itself, right? Or it's maybe some of these local banks.
Everybody, please make sure you follow Danny Moses. I appreciate those that joined. Good room here. Great discussion. Please make sure you support all these gentlemen, and hopefully I will see you all again